Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hi, everybody. Welcome to Vantage Point with True North Wealth Partners. I'm Andy.
Eric Susie.
And it's episode 32, Monday, March 6th, 2023.
Awesome. All right, we're into March Madness.
Yeah.
Woo. Who's your team?
No team, man.
I know. So do I. It doesn't matter.
I couldn't even tell you who's playing. I couldn't even tell you who's... Couldn't even tell you.
Yeah. No, I hear you. Good, man. You all right? Family? Busy?
Yeah, we're busy. Yeah,
cool.
Things are going well. Yeah.
All right. That's good. I made it back through that, my little Daytona 500 trip with my yearly getaway. So That was a good time. 13 guys all went down. That was crazy. So grew a little beard for a few weeks. All had to cut it off.
Yeah.
So it's all gray and white. Doesn't look good. Getting old.
Yeah.
All right.
Yeah, good. Yeah. Glad you had a good time.
Yeah.
Recharge the batteries a little bit, right?
Yes. Yep.
Yeah.
Well,
so what's going on? What's new? The markets are kind of. This has been the most difficult market, probably, right? In probably the last 2-3 years.
Yeah,
right?
and I would say a lot of that is something new. Chicago Board of Exchange, CBOE, and what they're starting to do now is daily 0 days to trading expiration. So 0 DTE, 0 days of trading expiration. That's for options. And instead of like a weekly or monthly option trading, which is common, now they're doing 0 trading days. So meaning people can buy the SPY, the SPX, SPYX, and get in there like 10 o'clock and sell it at 2 and manipulate the markets. Mm-hmm. So a few weeks ago, there was like 50 million trades approximately for the 0 DTE expiration for the SPY. And that was like the most ever. That's coming from Hedgeye, one of our research partners that we utilize. Mm-hmm. And then last week, a big intraday swing, which is huge. This was on Thursday, March 2nd. So the low for the S&P intraday was 39.30. The high was 39.88. And that's the range for the SPY, this index. And it closed at 39.81. And the print, it's just amazing. The calls that just bounced around. They had a call. They wanted to be 44,000 March 2nd, 3,980 calls, and it hit it because it closed at 39.81. So the point is that these market manipulators are manipulating the market intraday during the day. It just brings out a lot more risk, both good to the upside for the index and downside. So when it gets bad, you're going to see even more volatility. So you know what they say, stair step up, escalator down. So that's going to even, when we do see the next pullback, we had a 5% pullback in February, we'll have more again of that, but just going to be faster and faster. So that's something new to the markets. So that's causing a lot of professional, institutional traders to scratch their heads. You know, Argus, Hedgeye, you know, other folks that we utilize. So I just wanted to point that out. That is new for this year. So so be aware, folks. You're going to see a lot of intraday changes in volatility because of the 0 DTE.
Yeah, and we don't trade options for clients. I mean, personally, maybe, but yeah, the clients accounts.
For clients.
But the I guess the point is that even something like that, it impacts everybody.
Yes, it impacts everybody.
So it's not just the options market, but it's the overall stock market.
Overall market, both good and bad. So there'll be a lot more head fakes going on this year. So just hang in there. It's going to be a range. I think I'm hearing 3,600 on the S&P low to 42. But I think you said earlier it's a little bit higher.
43.
43 you heard from the
but
person?
Next, 42 and then 43 next leg up. So,
right.
But,
So
but we're only in
the range.
March.
Yeah, right.
So
I hear you. Crazy times. Good.
Yeah.
So what are you hearing else on some market indicators?
So jobless claims are down still. So we still have pretty good unemployment, or fairly high employment.
Yeah.
Which overall is good. So that's an indication the economy's probably stronger
Yes.
maybe than they had thought.
Right.
Staffing, right? We're just talking about that. So that's kind of an iffy,
Yeah,
a little touchy subject.
has rolled over some. So that's a leading indicator. And I got something from Sentiment, a trader as well this morning on that, plus our charts. So, the staffing is a leading indicator because employers can hire folks at will, but also they're the first to fire is staffing, the temporary employees. And that's now curling over and lagging last year.
Yeah.
So that's an early sign of what's to come, possibly. So just be aware of that.
Yeah, so retail sales are up, which is good. Box office tickets. I took family to the saw. What was it, Creed?
Oh, you did? Okay.
We saw that. Yeah.
Right.
So theater was packed. I hadn't seen that in seems like forever.
Yeah.
It seems like whenever we do go to movies, it's not that crowded. So that was good.
Good.
And then and then with home sales, right? So we're in a situation now where you have low interest or high interest rates. So if you were thinking of selling your house, you're probably going to hold off, right? So now we go into a situation where it's still a seller's market, right? Even with higher interest rates, and but you always have that group, right? It's like the transfers of people that have to sell and have to buy, but if you're on the bubble, like, hey, I like to move to this or there, you're probably going to hold off a little bit.
Rate locked.
Who's going to go? Everybody's sitting on 2-3%,
2-3% 30-year fix. Why would you go out and get a 7%?
Yeah.
So, my brother told me last week that his company there it hit over a 7% briefly last week, and now it's right around in high sixes right now. But the point is, it's going to be interesting.
Yeah. My first house was 7%. I remember that.
No, I hear you.
A couple years ago.
Good.
I'm just kidding.
GDP, I think just briefly on that, the nowcast. So Federal Bank of Atlanta just came out March 1st. The GDP nowcast revised down from 2.8 down to 2.7. The next nowcast alert, the little push out, was tomorrow, Tuesday, March 7th. But the point is this: it's everything. Either hedge is going to be really right or really off this time. So, all these intellectuals are pricing in positive GDP for 2.3. This is for the first quarter. So we'll see as the first quarter comes to an end here, at the end of the first quarter.
Yeah.
But Hedgeye has a negative over 2% print. So that's a major disparity between a positive over 2 to a negative -2. So we'll see who's right. But there's going to be a shock and awe coming one way or the other in the markets over the next here, I'd say 2 months.
Yeah.
So, strap in.
Sure.
And economists are stating, hey, pushing back the date of the recession, and, it could be a little bit later on and what have you. So just a lot of, it's the hardest, like you said earlier, you started out. So economists, the people that do this for a living day in, day out, they're just throwing darts in the air based on economic income or data that's coming in daily. So, got the head on the swivel, you got to OODA loop, observe, orient, decide, and act, and make changes and pivot accordingly. So that's what we're all doing.
Yeah, insider sentiment, the CEO sentiment is back. It's just it's crazy.
Oscillates, right?
Yeah,
it's
back.
crazy.
I've never seen it move so like back and forth on it. So, but the play right. We're obviously a little bit more defensive.
Oh yeah.
So it's just I think let's.
Yep.
The blue sky is not there yet completely, but you're starting to see it. But just be patient.
Right. Yeah.
So
that's the trading range. You're gonna be range bound for a few months at least through the summer. So hang in there. The rebalance. You'll see a lot of trades coming from me this week. So particularly, so I just want to make you aware of that from my clients viewing this. So again, just still on the defensive, cautious side. Just introducing some other alternatives and things of that nature, just to spread out the risk. Bringing in the treasuries. We talked about that. There's finally income in fixed income, so you might as well utilize it.
yeah, that's the interesting. The bond plays, right? You could,
finally.
I mean, you could get equity type returns in bond funds.
Yep.
next few years maybe. So
Yeah.
we got our eye on that.
Oh, yes. Yeah.
So yeah,
I hear you. Good.
interesting. So yeah, so the I know we talked to the last couple times. So at the end of last year, Congress passed Secure Act. So
Yeah.
pre COVID or right when COVID hit, they did. It was called Secure Act 2.1, 2.0, or wait, no, Secure Act.
Yeah, just
The first Secure Act, and then at the end of last year, they got through. It was called Secure Act 2.0.
Correct, yeah.
So it just kind of built upon some of the COVID policies that were implemented. And there's actually some good stuff
Some good
in there.
stuff. Yeah.
The big thing, of course, was the required minimum distribution age. So it was for the longest time was at 70 and a half, right? Then they moved it. Then with the Secure Act first one, it was 72,
right.
and then now eventually they want to move it up to where it's 75. But there is kind of a stair step. So we had created a kind of a cheat sheet or shortcut.
Yeah.
We can put that on the screen. Show.
You guys
so
can see this. Yeah.
yeah, so for most people, like if you're taking your RMD right now, you got to keep taking it.
Right.
But if you're born 1960 or later, your age it's 75. If you're born between 1951 1959, it's 73.
Right.
So it makes it a little bit easier, I guess. Just gives you a little bit more time,
Yes.
when you start to pull that tax
Yeah.
money out. And no, if you have a 401k that has a Roth side and you keep it in there, it used to be at 70 and a half or at whatever age it was, the required minimum distribution age. No matter, even if you're working, you had to start pulling money out.
RMDs.
So that's
Now
gone.
It's gone, right?
That's gone, yeah.
Yay, finally.
Yep. Yeah. So a few other key provisions would be
Yeah.
like the 529 money. So it
Yeah.
used to be, hey, my kids got scholarships, or I got 20 grand left in my 529, and I can't do anything with it without being penalized.
Yes.
So now you can move that into a Roth account. However, it's not quite. Yeah, it's
A lot
not.
of caveats. Open for 15 years. You can't do the last 5 years contributions. And
Yeah, it's not quite. You think
Yeah.
It's from the government, right? So
Yeah.
it's not. It's not as
easy.
straightforward.
Nothing's
as
easy.
it should be. So, but that is an option. So you can work. Eric and I can work
Yeah.
with you guys on if that's something that is an issue. We'll come up with a strategy on that. And then a couple other big ones were the student loans. So like if you have student debt, you put money in your 401 instead of the employer matching in your 401k, they can put some of those dollars to down, kind of pay off your student loan debt.
Right.
So there's some good provisions in there.
Yes. That's good. No, all right. So that's just a few things I wanted to hit on that. Let's see. I guess just one thing about M&A, mergers and acquisitions. So it has picked up. M&A deal activity. This is from FactSet as of February 22nd. So M&A deal activity increased in January. It's up 5.8% with 1,278 announcements compared to 1,208 in December. However, the aggregate M&A spending dollar amount has decreased. So in January, it's 28.8% less was spent on deals compared to December. So the sizes and the amount spent is less, but the number of them are increasing. So we anticipate, we have a fund we're using, the M&A fund, merger and acquisition fund. We anticipate that still being good this year, even with the choppiness of the overall stock market. That's why we still have that holding. So I just wanted to point that out. And just overall, it's a nice little quick chart, just visually. Trend just showing you M&A activity bouncing around, went down, and now it came back up somewhat. So just a little M&A chart that we track on. And earnings overall has decreased by 5.7%. So that's just also coming by FactSet. So the decrease of 5.7% in EPS estimates for Q1 of 2023.
Earnings per share.
Earnings per share. Yeah, so that's good. We've been talking about this for half a year now. They have to come down. So the analysts have them all way too high, so they have to reset them, bring them down lower. So they're starting to do that, which is good. So it's all part of the bottoming formation and getting that processed for the next.
How much do you think's built into the market already on that?
The earnings per share coming down. I'd probably say about 50 to 60% there. So we're over the halfway mark. So there'll be a few surprises these next 2 months. So strap in. There's gonna be some major.
Both could go both ways.
Both
right?
ways. Both ways.
Right.
Yeah. So that's why we're not quite ready to get aggressive with the models yet, but we will, just not quite yet. So I just wanted to cover all that. Anything else on your neck of the woods before we get into some other items of tips of the month?
The tips of the month. Yeah, no.
Yeah. All right.
I'm pretty boring, I guess.
Yeah. No, that's all good. But a couple little stats. This came out from what's the magazine here? FA Magazine, Financial Advisor Magazine. This is dated on 2/24 of 23. So the number of 401k millionaires are shrinking. This is just a stat. I'm going to read this a little bit here. So Fidelity, the 401k millionaire club has shrunk by a third. Okay, so Fidelity Investments had just 299,000 millionaire workplace retirement accounts at the end of 2022 versus down from 442,000 a year prior, according to data from the asset manager. So again, Fidelity's published that. So basically, it shrunk by a third. So that's a lot.
So that's just their 401k.
Just the 401k.
So Fidelity says, okay, who has $1 million?
Yep. They take a snapshot. Yeah, end of 2022 versus end of 2021, the year prior, and it shrunk. So it shrunk by a third.
Yeah.
That was an interesting little fact. These are just little side ones, little quirky things, but this is coming from the Hedge Eye, the demographics from Neil Howe on 3/4. But interesting, because I'm a car guy, so I grew up driving stick shifts, all that stuff. But finally, sales of manual cars have grown for 2 years running. So manual or stick shifts are coming back in popularity. So for a decade long, the decline of sales of manual cars are finally growing. Manual cars account for 1.7% of total new car sales in 2023, according to J.D. Power, up from 1.2% last year, and a low of 0.9% in 2020. So 2020 is 0.9, and then it went from up from 1.2 in 2022, and then 1.7 is this year. And it's millennials. Basically, they want stick shifts. And Acura discontinued the stick shifts in the 2015 Acura. They brought it back for the Integra in 2022, and it's going to be released a new manual-only model for this year, and that's for the Integra. BMW, same thing. The Mini Coupes, they're bringing them out. So just more of those cars, and the millennials, basically under 46, are really intrigued. And another little factoid, tips of the month, the Tooth Fairy. So yes, I have done the Tooth Fairy. It has come from my children. But anyways, so back in the old days, 1998, this is according to Delta Dental. So they do this poll for parents for between 6 and 12-year-old kids for the past 25 years. Okay, so they've done this for Delta Dental. The national dollar amount back in 1998 for a tooth was $1.30. $1.30. Okay, so what do you think it went up to?
$5. Close.
All right. So
I guess.
So it's been creeping up steadily. In 2023, it hit a record high of $6.23. That's crazy. It's called the Tooth Fairy Index. So just something a little peculiar out there, but I wanted to at least, you're not going to hear that in the everyday news.
Sure. Hey, speaking of that car thing, real quick, you're talking about, there's a new Turo. Have you heard of that? So it doesn't
come to memory. No.
So it's kind of like it's like an Airbnb, but for cars.
Oh yeah, okay, yes, I have heard of that.
Yeah.
Yes.
So it's pretty cool. So you can
rent.
Yeah.
Right.
And I'm not a car guy.
Right.
I'm kind of bored. The Honda Odyssey. You can't. But anyhow, but I'm taking my son away on a kind of a man's weekend. We're in Gettysburg, so I thought he is a car guy.
Cool.
So I got on there, and you can get.
Yeah, you can rent.
You can rent like a Tesla. You can rent a Porsche. Anything about any car you can think of. That if someone owns it around, you can say, "Hey, I'll give you $50 a day."
Right.
So it's kind of funny. So I got this Mercedes.
Sweet.
It's super
Sports
cheap.
coupe.
Yeah, I just rent it for like 3 days. It's gonna be. But
good for you. All right, man. The Smiths be driving in style.
Yeah,
all
right. Yeah. But if you're looking for it's just kind of a cool thing, like a weekend trip, or hey, I'm gonna do something fun. You can get on there and just mix up a little bit.
Yeah. Put the miles on that car instead of yours. So.
Yeah.
It's good. We've done that for vacation trips. Actually, we rented a van and just
Sure.
Plow it on there.
Yeah.
All righty, folks.
All right.
Well, let's get into the good old charts here. So this is the monthly review. So we're going to change up. Start with the bond market volatility. So This is you heard of the VIX, but this is the bond or the MOVE index. Is the volatility for the bond market. So as you can see, the average is 83. It spiked back up of late this past few weeks here, went back up to 122. Coming off the highs, it was much higher in the 150 range, but it's still elevated. And with the Fed still going to be raising rates, yes, we're hoping it could be 3 more times, but a quarter. Point here at the March, they take a pause in April, May, probably raise another quarter. Then June, we'll see. By then, the market's being so crazy, we anticipate by then they may pause, but they may do one more 25er. So 2 or 3 more 25s is what we anticipate, but you're going to see this bond market move index still go all around. This is the VIX, the volatility index. This is what the CBOE, Chicago Board of Exchange, with the options traders think that the volatility will be 30 days going out in the options market. So the average is 18.7, and right now it came back down to 18.5. Last week it was 23, almost right around the 23 range. So it's going to be bouncing all around. So you've heard of that all we've covered that. Pullbacks, there's the number one. So finally we hit number one. It's a 5% pullback in the S&P. The average has 4.6 times, so almost 5 times a year. You're going to have a 5% pullback in the S&P. We've hit number one. Members, recap, January was a great month. Starting heading out of the gates early. February decline. March looks like it's going to be back and forth. We'll see, but we anticipate that you'll see another number 2 next month when we come back on that. S&P earnings. Finally, the earnings per share is coming down. So the average historical is 7.9. Right now it's 4.0. So it is coming down, and things are getting adjusted. Mm-hmm. So that's part of it. The 2-year, 10-year. Just as far as interest rates and the hikes, you can see it spiked back up last week, both in the 2 and 10 year. So well above the average of 2.3 in the 10 year. Right now, 4.86. 3.97. That's in the 10 year. The 2 year is 1.06 is the average. And then you can see it's right now 4.86 for a 2 year. Mm-hmm. So the inversion, all that means is you're getting more yield on the short end of the yield curve rather than owning longer end durations of a 5, 7, 10,
which is the opposite. Which is the opposite of how it should be.
It's the opposite. So these are all leading indicators. When it's inversion, typically you go into a recession. So we'll have another chart on that in a moment. So the 2-year, 10-year, the recessions are shaded. The recessions don't show up sometimes on this. It's hard to see. But the point is right now it's 0.89% inversion. Quite frankly, it went over 9. It's over 9 now. And what I'm hearing is going to be over 1, so 1.0 inversion rate as far as the spread. So anticipate that getting worse, and this is the worst it's been since the 80s. So just keeping that in check and keeping it real. Mortgage rates, so you can see the average since 1990 was 6%. The average since 2008 is 4.1, but prior to last year, you can get rates, remember, 2.5, 2.75 for 30-year fixed. So when folks have pretty much locked in at a much lower rate, it's spiked up to over 7. Right now it's about 6.7 as for a 30-year fixed. Fed funds rate, again, we talked about they could keep on going longer and 2 or 3 more quarters, and then they're going to pause, and I don't know if they're going to be a cut or not. They may have to, depending on how bad it can get. By November, December, but we'll see. Dot plot, again, this is all the Fed members meeting. These are their individual votes. It's subjective, so it changes and moves. But these are just the dots. Each blue dot represents a voting member's argument of where they want to see it. So it's going to be there longer, higher for longer. This is some good news, finally. So quantitative tightening, remember the $95 billion behind the scenes. Now, they're not hitting that number every month, but they're letting it roll off the balance sheet. So the Treasury's mortgage-backed, they're letting that roll off. So it's finally curling back down. So this is good. So it was well over $9 trillion. Now it's about $8.3 trillion. So slowly but surely, again, they want to get it down to that $4-5 trillion range over the next few years, but at least they're making a dent into it. So that's working behind the scenes. A lot of currents underneath the water that you're not seeing. So hence why these rates in the MOVE index, it's all part of it. Leading economic indicators. These are recessionary right now. So We're in at minus 5.9. So again, every time you're down like that, you'll see recession, recession, recession. So, how they come back and determine it, that's for the Harvard folks to rewrite the history like they always manipulate things, but it is what it is. Wage growth, this is all part of it too. So wages have been going higher to try to keep up with inflation, but it's artificial. They need to come back down to a national average of the 3% range. So at least it's going in the right direction, coming down off the 7+%, going down to 5.1% right now. CPI, we talked about that. These next 2-3 months, you're going to see major decline in inflationary. So that's all rate of change, rate of change. It's all going to be going lower at a faster clip, and then it's going to level off and stay sticky and higher for longer. So yes, that CPI you'll see in the 5s and the 4s, but they'll be leveling off in that range. That's for the core CPI. PCE is what the Fed follows. They want to see that at 2%. Yes, it's come down off the high 6 watermark, coming down to 5 and 4. Again, 4, 3, but it's going to be sticking in that range for a while. You're not going to see a 2% print this year on that at all.
Yeah, no way.
Yeah. Building permits, what you talked about earlier, building. You can see the boom, spike down, the crash of 07, 08. The housing came up, crashed in the COVID mancha there in 2020. And then up, and then the crash again just recently here. So you can see how it's coming back down. So building permits, the average is 1.3. So we're right at the average of 1.3. But however, this is going to be a thorn in the side for the next year or two. Oil and the dollar. So oil has come off the high. The oil's on the left index. You remember it's about 120 or so. Now it's in the 80 range. So that's good if it can stick in that range, 70 to 90, let's call it. And the dollar went straight up on the right axis. The dollar was weaker, but it's come back off. So it was high, 115 almost, and then went back down to around 100, and it came back up to about 105 or so. So that's the dollar. It's going to be interesting to watch those work its way over the next 6 months. Stock market bull and bears. So we talked about this, just updating the longevity of this. So we're well into this. Recessionary / bear market cycle. It's 1 year, 1 month now as a duration. Has ever been on the water there. So that's good. We're just getting closer to the end. So we're almost there.
Bulls
since
win.
1956, the average bear market's lasted 1 year, 2 months with a decline of 36%.
All right.
So we're 1 year, 1 month.
Yeah, not quite as bad down.
Yeah.
But good.
Personal savings rate. So this was a little outlier that came in January. That's the COLA. Remember the cost of living for Social Security, 8.7%. So a little jingle money. So the people, that's why you see the spike up. And that's why in warm weather, jingle money came in, boom. That's why January was great. February reversed. We'll see how it all shakes out. But it came off the low of that 2-3% savings rate, well off the highs of the 25 to 35% range during the COVID tenure. So the historical average for savings rate is 6.8. Currently, it's 4.7. I do anticipate it going back down again, crawling back over. So be on the eyes, watch for that. And the economic commodity index. So just interesting here, going back. It's pretty much sideways. Things are leveling off and just going sideways, a little bit up and down. But from 2023, July of 2022 through now, you can just sort of see going sideways. So. Again, the worst, we hope, of the inflation, it is past us, but it's going to be sticky and longer for normal. But so I appreciate you joining us here. Like I said, little tweaks that have occurred and will continue to occur this week. And let's see, as far as, sorry about this is the February / March one, just because of we had a scheduled guest host last week, but he was sick, I was sick. So I got up through my bronchitis and all that junk. But anyways, so this is being our combo one. So with that said, please reach out to us. Any questions, hit that subscribe button, like us, follow us, and then we will go from there.
All right.
All right, you guys.
See everybody. Thank you.
Take care. See you next time.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss.